Here is the English translation of the news script, based on the provided source material regarding the gold market's performance during geopolitical tension. News script: Decoding the gold market. The truth behind the safe haven role. Welcome back to today's financial bulletin. A question currently capturing the attention of every investor is, why, when geopolitical tensions are through the roof, is gold traditionally considered the ultimate safe haven, not soaring to decisive new highs? Has the fundamental theory behind gold changed, or have we simply misunderstood how this precious metal operates? 1. The myth and reality of the safe haven. For decades, gold has been the asset investors instinctively turn to when confidence in financial markets begins to weaken. Gold holds a unique position because it exists outside the network of promises and liabilities that underpin modern finance. It cannot be printed by a central bank and does not rely on the fiscal discipline of any specific government. However, the sources reveal an interesting truth. The relationship between geopolitical events and the price of gold is more complicated than commonly assumed. Typically, gold responds more strongly to the long-term economic and monetary consequences that conflicts eventually produce, such as higher government spending, rising public debt, and inflationary pressures, rather than just the immediate outbreak of hostilities. 2. Lessons from history. Let's look back at historical milestones to see this pattern in action. The Gulf War, early 1990s. Uncertainty pushed gold prices higher before the conflict, but once military operations began and the scope of the war became clear, the earlier momentum faded. The invasion of Iraq, 2026. A similar pattern appeared. Gold strengthened during the period of uncertainty preceding the conflict, but struggled to maintain that momentum once hostilities were underway. The Ukraine conflict, 2022. Gold surged above $2,000 an ounce as an initial reaction to the shock, but quickly adjusted as central banks began tightening monetary policy aggressively to combat rising inflation. 3. Why is gold hesitating right now? According to expert analysis, there are 3 primary reasons why gold hasn't made a definitive breakout yet. Competition from other safe havens. Investors don't just choose gold. Capital moves between various perceived refuges, including the US dollar and sovereign bonds. When bond yields shift, it directly impacts the attractiveness of gold. Liquidity needs. During periods of sudden uncertainty, there is often a scramble for cash. Investors may sell profitable, liquid assets like gold to meet margin calls or rebalance their portfolios. Consolidation phase. Following a powerful rally over the past year, the market may simply need a pause to digest those gains and consolidate before moving higher. 4. Message for investors. The true significance of gold is not as a perfectly responsive indicator of every crisis, but as a tool for preserving purchasing power during periods when the financial and monetary environment becomes unstable. The takeaway: rather than focusing solely on daily headlines regarding conflict, investors should pay close attention to how governments and central banks respond to the resulting economic pressures. Those policy responses, the fiscal and monetary consequences, are the deeper forces that traditionally drive gold's best performance. Thank you for joining our bulletin. Remember to keep a cool head and a long-term perspective when participating in the gold market. Goodbye, and see you next time.